Good morning and welcome back, everyone, to our Options Education Tuesday Market Outlook session. My name is Tony Zhang. I'm the Chief Strategist here at Options Flight. And markets have continued to melt higher, if you will, but things have continued to diverge quite a bit here from where equity markets are currently trading. So today we're going to look at some of the underlying data that helps us better understand the current market rally and some of the sectors that are currently at play in the current market environment. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off by taking a look at the broader equity indices just to see where they currently sit. Like I said, we've noticed quite a bit of divergence now from the major equity indices. So we want to make sure we highlight that and understand what the risks are when equities continue to push to new all-time highs despite these divergences. Then we'll take a look at where interest rates currently sit and how they've effectively allowed for this current equity rally to continue. Then we'll take a look at the sector rotation model, which I think on the surface, when you look at it, starts to show a little bit of sector rotation, which generally speaking is healthy for a market rally. But I do want to take a deep dive into some of the major sectors that are rotating higher versus rotating lower to give us a better sense for whether we see that they're going to continue or not. There is some evidence that some of that rotation that we're starting to see is not necessarily very strong. Then take a look at some of the economic indicators from an inflationary perspective to help us continue monitoring this debate as to whether the current inflationary environment that we're in is more transitory or more permanent before sharing with you some of our ideas. But the primary question that I want to help investors answer from today's session is really, is the current breakout that we're seeing in equities, an opportunity for investors to look for further upside? So my name is Tony Zhang. I'm the Chief Strategist here at Options Play. And what I want to share with you today is predominantly going to be along the lines of technical analysis, looking at market internals, looking at sector rotation to help us understand the health of the current market rally as we continue to see equities melt up higher. So when we look at the S&P 500, on the price action perspective, we continue to push to new higher highs on the daily chart. The weekly chart remains extremely strong and upward to the right-hand side. But some of the things that are concerning to us that we see is that as the S&P 500 continues to print new higher highs over the past few weeks, we continue to see lower highs on momentum. These are signs that there's starting to be exhaustion. There are signs to be, there are negative divergences with momentum on each breakout higher. This in itself is not necessarily a risk, but it does elevate the probability of a pullback here in the current market conditions. But right now we're not quite overbought, so this can continue to move upwards and higher. However, we do have to look at some of the other markets to help us understand this current market rally, because the NASDAQ 100, which is lagged behind the broader markets for the better part of Q2, has really started to accelerate here to at the end of Q2 and breaking out to new all-time highs and continuing to push higher here. Now, this is really where the same momentum negative divergence that we talked about here over the past few months has started to actually reverse. We've started to see higher highs in price actually be confirmed in higher highs in momentum. So this is actually constructive for the NASDAQ 100 relative to the other market indices. So technology is not only outperforming, but the market internals for the technology sector is also looking fairly strong here. While when you look at the small caps IWM, the Russell 2000, we continue to see the Russell 2000 trade within this range. So lacking the momentum, lacking the relative strength to break out higher here. So relatively speaking, small caps is underperforming the broader markets. And lastly, RSP. This is what's, for me, fairly concerning when you look at the equal weight S&P 500 index failing to make new highs while the market cap S&P 500 continues to make new highs. This is showing us that the broad number of the stocks within the S&P 500 is failing to break to new all-time highs. And for those of you that are followers of Dow theory, you might be more familiar with the concept of when the S&P 500 makes a new high, you want to see the Dow Jones Industrial Average make a new high as well. But so far, we're actually failing to see that. The Dow Jones Industrial Average continues to actually make lower highs. Same thing for the Dow Jones Transportation Average, continues to make lower highs as the S&P 500 makes higher highs. And this overall divergence is, generally speaking, not particularly healthy for the market. Now, just because these fail to make new highs in itself is not bearish per se. It does have the opportunity to catch up, if you will, and confirm those new highs. That's always still in the cards. But the more of these indices that require breakouts to new highs before these the current breakout that we see can be confirmed, the less likely we're going to see this, especially when the Dow Jones Transportation Average is fairly significantly below the highs that we've seen here in May or so. So these are some of the things that are just starting to emerge that I think investors need to be paying attention to as equities continue to push the new all-time highs, especially within more peak valuations. But the one thing I continue to remind investors is that these types of conditions can actually go on for weeks, sometimes months. We saw it right before the pandemic sell-off, where the markets effectively had similar price action for almost 4 months before the coronavirus effectively sent the markets tumbling about 35%. But these conditions existed for about four months or so as markets continue to push the new all-time highs. But these other indices did not confirm those new highs. We started to see negative convergence. The number of percentage of stocks trading above its 50-day moving average right now is fairly low here at just 54%. That's a pretty big divergence from markets trading near all-time highs. So these are the things that you need to be concerned about or be aware of as you continue to invest in equities pushing to new all-time highs, and thinking about the trade structure you're using, whether you're pushing brand new highs, brand new long positions, or using these opportunities to take profits. So when we look at interest rates also, we've seen this 10-year yield really find a bit of equilibrium here around 150 basis points or so. So we really have found a bit of fairly tight range between 145 and 155. And I think as far as what's going to settle the breakout here on one way or another is going to be this debate between inflationary, whether it's transitory or permanent. We're going to take a look at some of those data points from an economics perspective to help us understand where they currently sit, because that's going to help drive your view as to where interest rates are headed going forward. And that's going to have a fairly large impact on your valuations or how you value stocks. So when you look at sector rotation, this is really where, we talk about sector rotation as the lifeblood of a rally. You need to see a healthy amount of sector rotation as equity markets continue to rally. And for the last 3 or 4 weeks or so, we've really have seen a lack of true rotation. And when you look at the change from last week, it's seemingly what we have is the start of some rotation. You have materials, financials, industrials, staples moving towards the improving category. You have communications starting to come down, energy, real estate starting to get back into the weakening, technology starting to come back down already as well. So as you can see, you see a fair amount of healthy rotation here, or at least what looks like the start of some healthy rotation. And if this can continue, that is what we need to see for some of these indices to confirm those new highs and for equity markets to continue moving higher. So with that, what I did want to do is to actually do a little deeper dive into some of these sectors that look like they're starting to rotate and see if we have the support or have the evidence that this rotation can continue. So the first one we want to look at is communications. Communications on a very strong weekly trend here, both on the daily and weekly chart. Daily chart yesterday started to break out to new all-time highs. And as you can see, it is largely confirmed by momentum indicators. So you're not seeing the same amount of exhaustion across the other sectors. So communications, one of the sectors starting to lose a little bit of relative strength here. But when we look at communications relative to the S&P 500, this is XLC relative to SPY, actually breaking out to new all-time highs or breaking out to new relative highs compared to the market. So this is showing us that not only is communication strong on an absolute basis, but also on a relative basis. So this leads me to believe that communications, the rotation in communications is not quite over. And then when you look at industrials, one of the main sectors that have underperformed here, showing some outperformance here over the past week or so. And the question is whether industrials and materials will continue to respond back to their double tops here around 106, 107 or so, and then continue moving higher, which has been one of the sectors driving some of the major rallies we've seen here in equities. But when you look at industrials, right now, it's back at the 21-day moving average. It is at risk of potentially failing and coming back down towards the 200-day moving average, or it could break out higher back into the 106, 107 area. But when we look at industrials relative to the market, this is really where the picture is much clearer. You see that clear decline here. And despite the rally we've seen here over the past week or so, industrials continues to underperform the broader markets. This provides further evidence that this rotation that we're starting to see into industrials may not last, and this could actually just continue to underperform the broader markets. You see the same thing in some of the other sectors like technology, or basically the exact inverse, where you see technology can break out to new all-time highs on an absolute basis, but if you look at technology on a relative basis to the market as well, remains extremely strong here over the past month or so. So this also leads me to believe that the weakening we're starting to see in technology may not stay, that we might very well may see a continuation of technology dominating this market and continuing to drive returns here going forward. And then lastly, looking at real estate, another one of the sectors that are starting to rotate lower here. We had the pullback here to the 21-day moving average. And then when we look at real estate relative to the market, as you can see, strong uptrend near a support level and potentially continuing to outperform the broader markets. So when you look at that sector rotation model, one of the things that really jumps out at me is the fact that we're starting to see what looks like some rotation, and the question is whether that rotation will continue. And when we take a deeper dive within the sectors, I don't necessarily see a strong case for a lot of rotation. I actually see some of the strong sectors remaining strong and some of the weaker sectors remaining weak. So that continues the market conditions that we've seen here over the past 3 to 4 weeks of a lack of rotation potentially continuing. So those are some of the concerns that I see with the equity markets in conjunction to the lack of confirmations we're seeing from the major indices. And then when we switch over to the economic data, this continues to go back to our research as far as whether the inflationary environment that we're in is more transitory or permanent. There's really two things that the Fed is looking at: labor and consumer goods in terms of pricing for consumer goods. So when we look at the labor market, there are some, I would say, highlights that are worth taking a look at. Now, we have 10 states where the federal unemployment benefits are about to expire here in this week or last week. And for the states that the unemployment benefits have expired, we see a fair amount of strength in terms of employees looking for jobs and jobless claims continuing to decline. And we see a clear bifurcation here between states that have dropped federal unemployment versus states who have not in terms of the number of new initial claims. And then also, if you look at job search data, the states that have dropped unemployment are seeing substantially higher search for employment versus states who have not. So there's this clear bifurcation, and this is one of the things that could ease some of the labor strains that we see here that are causing some of the more wage related inflationary numbers at the moment. Now, the question is certainly, yes, unemployment claims are dropping. The question is whether that these people are getting back to work or not. That's going to, if we do see a significant increase in workers entering the workforce again, that's going to ease some of the wage inflation that we currently see. But if you look at the underlying data from the manufacturers in terms of what they're paying in wages and benefits, that continues to creep higher here. And now, I'm sorry, I don't think creep is the right word. It continues to accelerate to the upside. We're seeing it on quite a few different indicators, but if you look at the Dallas Fed manufacturing wages and benefits, we continue to see an acceleration here to the upside. And also, if you look at unfilled orders, this speaks more to the wage and raw material constraints that we continue to see here. The unfilled orders remains extremely elevated here at the moment. So, and it has remained elevated here for the past 3 months. And if it continues to remain elevated, that's really further evidence that the inflationary concerns that we have is lasting longer than the Fed may be anticipating. And those are some of the reasons why we could see a faster tapering in September, or potentially raising interest rates faster than expected due to inflationary concerns. So this is an ongoing debate, I would say, and this is something that we have to continue monitoring the data every single week to get a better sense for whether these inflationary concerns from a wage and consumer goods perspective are starting to ease, or they continue to remain elevated. So far, the data still remains fairly elevated across the board. So when you look at everything on balance from what we've discussed, there's no doubt that the overall trend of the broader markets, equity markets, is still to the upside. There are warning signals that are continuing to, I would say, emerge from the divergence indicators, the somewhat lack of rotation that we're seeing from the sectors, and the pullbacks that we have seen in some of the major indices. But like I said, on balance, you are still in a bullish market, and these conditions that we've noticed have only lasted about 3 to 4 weeks. And we know from history that many times some of these can last for 3 to 4 months. So just noticing divergence, just noticing concerns of exhaustion or signs of exhaustion in itself is not a good reason to go out there and short the markets. And statistically speaking, that's not a good has not been a great strategy during these conditions. Things can get far more extreme than where we are right now before you see those types of sell-offs or more violent sell-offs in the markets. So when you look at opportunities here in this market, my preference is still looking for strong stocks that have pulled back, that have strong fundamentals to look at from a quality perspective. And some of the names that screen well for this are Southwest Airlines. When you look at the airline data right now, we continue to see extremely strong TSA data, especially when you look at the domestic versus international routes. And Southwest Airlines is one of the few names within this particular space that is fairly well exposed to just domestic leisure travel. And we've seen a significant decline here in these stock prices over the past few weeks. I would say that some of that is due to concerns that fuel prices have started to emerge. Southwest Airlines is one of the few airlines that actually hedge their fuel cost. So as you see Southwest Airlines started to pull back to these support levels around the 200-day moving average, which comes down around the $52, $53 level, these are the opportunities that I like to look for in current market conditions. Now, Southwest Airlines has pulled back here to this $52, $53 area, fairly oversold here, as we've seen from the RSI perspective. You see a double bottom here from an RSI perspective, started to see some negative divergence here, or positive divergence here as well from Southwest Airlines. So this is one that that I'm currently taking a look at for a bounce here in industrials. The second one we want to take a look at is DR Horton. So home builders also have seen incredibly strong numbers, but have seen pullback with the industrial market or in the industrial sector here. DR Horton has pulled all the way back to this $84 level, which is the breakout level from earlier this year, pulled back to the 200-day moving average, and so far has held that 200-day moving average, potentially looking for a bounce higher here from the home builders, where inventory levels remains at multi-year lows, and home builders have remained extremely resilient during that time, and we're just simply looking for a potential bounce. And lastly, within tech, you have to look at, in my opinion, for quality here in the current market conditions that we're in, especially when tech valuations are trading at very, very rich valuations. there's a pretty big bifurcation between tech companies that are not profitable versus tech companies that are highly profitable. And Microsoft certainly stands out from that field with respect to high margin business, continues to grow fairly well with respect to their cloud business. They're number 2 relative to Amazon. It is overbought. So this is one that you have to be very careful on. I don't necessarily think that timing on this is the best. As you can see, we are in the top of the channel here for Microsoft. You typically, as you can see with a channel like this, you want to wait for a pullback towards the bottom of that channel from a timing perspective. So this is one that I think is worth paying attention to, but this is not, from a timing perspective, the best time. But as you're looking for opportunities here in this market, quality is going to be where you prefer to be rather than the high growth, high beta tech names that are not profitable here in the current market conditions. So those are the names that we're currently paying attention to here right now in the current market conditions. So with that, that covers what I want to share with you here today. I hope that this was helpful in giving you a better understanding as to the current market conditions and what we're paying attention to with respect to the indicators. Like I said, on balance, things are still moving in the bullish trend. However, we are starting to see more and more warning signals, if you will, from the divergence perspective, from the lack of rotation perspective. So these are things that you need to be aware of as you continue to look for opportunities here in this broader market. With that, thank you so much. I hope that you guys have a great trading day, and I'll see you guys here next Tuesday morning. Have a great trading day.